Peter, does the name 3 Mile Island mean anything to you?
Yeah, I grew up in Pennsylvania, so everybody knew about that 70s nuclear scare.
Well, reopening 3 Mile Island has been one of the hottest investment ideas recently.
That's right. I did a story last year on hedge funds who've been buying up nuclear stocks as a way to bet on AI and its big power needs.
Well, our guest today is one of those fund managers. We'll get to that in a bit. Hey, everyone. I'm Telis Demos. I write for the Wall Street Journal's Heard on the Street column. And this is WSJ's Take on the Week, the weekly show where we give you a leg up on the worlds of money and investing. Each week, we bring you conversations with insiders and from inside the Wall Street Journal's newsroom about money, finance, banking, bonds, stocks, all that good stuff. And this week, I'm so excited to be joined by my longtime colleague and Wall Street Journal reporter, Peter Rudegeair. Peter's joining us while Gunjan's away. Peter, welcome.
Thanks for having me, Telis.
Well, we're going to throw you into the deep end, and we're going to talk about what we seem to always talk about, and that is inflation. We've got additional data. We have the personal-consumption-expenditures index, the PCE, which is not necessarily super different from the CPI and the producer price index, but it is the thing that the Fed looks at. It's the most comprehensive inflation measure. And so, of course, the CPI came in a little hot for January. We'll see if the PCE does as well. But I think what's interesting is that there is still an expectation in the market that the Fed is going to cut rates at some point this year. How can that still be the base case, do you think?
You know, it surprises me. I think one interesting tidbit into how inflation has been kind of sticky was in the Journal this week about something called the Egg Clearinghouse. The price of eggs is obviously a meme on inflation, but unbeknownst to me, there is a Wall Street of eggs where farmers and buyers of eggs can come together and try to get extra eggs. And right now, there's really no sellers. It's all buyers. The supply has totally gone away. The demand is still through the roof. That's just a little capsule of the inflation picture as it still is. So, yeah, I am as surprised as you are that a lot of investors are still expecting some more rate cuts.
If there's a case to be made that we're once again looking at transitory inflation and not the kind of like sticky long-term price rise that's driven by like kind of fundamental factors. But look, there's something going on in that market, and that's what's driving up the grocery basket, which, as we know, was like one of the major factors in January's kind of hot reading.
Yeah, and just for future inflation expectations, you're seeing some restaurants now adding surcharges to eggs, putting lines on the menu saying, hey, it's going to be 75 cents, $1 extra if you have eggs. So as that feeds into people's consciousness of now we're expecting more price rises or those to continue, what does that do for inflation expectations?
That's a great point. Inflation is as much about psychology as it is about the numbers. Well, one inflation that I think we want to kind of think about for this upcoming week as well is home price inflation. Obviously, we all kind of benefit. You know, anybody who's a homeowner likes to see that. But I think the market, though, would like to maybe see home prices start to slow down. We get a reading this upcoming week, the S&P CoreLogic Case-Shiller National Home Price Index, kind of the benchmark, I would say, for home prices. That's still rising, but it was slowing going into last year. And the reason I think that maybe slowing prices are good is because that might open the market a little bit for buyers and sellers. So much of the market, a lot of companies really depend on sales, right? Buyers and sellers, people who write mortgages, brokerages that make deals. We're going to get earnings reports from Home Depot and Lowe's, right? Those companies benefit when people go to the store to fix up their home or get a new one. And I wonder if home prices do slow down gently, obviously a crash wouldn't be good, combined with now we've got mortgage rates back below 7%. They're back in the 6-ish percent, the high sixes. If that's enough maybe to start opening the market a little bit.
I wonder how durable you think that fall in mortgage rates is. We've seen kind of long bond rates kind of stay pretty elevated.
Yeah.
I think those are pretty correlated with mortgage rates historically, right? So if those stay pretty high, how much relief do you think consumers can expect on kind of mortgage rates and mortgage payments?
Yeah, that is a great point. Though I will say that even though rates didn't go back to the 2-3% kind of craziness that we remember from several years ago, the market did pick up late last year when rates were closer to 6%. So I don't think it'll take a huge drop, but to your point, as long as those longer-term interest rates, which is really what mortgages are priced off of, stay up. And that, has as much to do with like inflation and the Fed as it does with, longer-term expectations for growth, the U.S. budget, fiscal conversation. But I still think, though, that it's worth paying attention to those earnings this upcoming week from Home Depot and Lowe's, as well as like any like kind of realtors that report, see what their outlooks are for the year. Peter, though, I want to turn the conversation to another kind of earnings, and that is for kind of AI-related companies. And,
Sure.
and I'm really interested in your perspective on this because your job here at the Journal is you write about hedge funds.
I do.
And these are, allegedly, purportedly, some of the smartest investors in the market. They're the sharks, we're the chum. And you wrote a fascinating story last year about how hedge funders had really keyed in on the artificial intelligence trend, but weren't necessarily just looking at, Nvidia or even, Microsoft or, Meta, the companies investing in AI, but they were looking at that from a different angle. Tell us about what they were looking at for.
Sure. So, when you and I hear AI, we think Nvidia. They're reporting earnings this coming week. It'll be a big bellwether for the whole rest of the market. But a lot of hedge funds, even those that bet on tech companies, gravitated to this pretty snoozy sector of the market, power companies and power stocks, companies that literally just make electricity.
Yeah.
And that's because the biggest bottleneck in the AI supply chain isn't a lack of NVIDIA chips or data center capacity. It's literally the power to power those data centers, to train the models, to answer your chat GPT queries. So we had a lot of hedge funds pile into stocks like Vistra, which is also reporting earnings this coming week, Constellation Energy, which reported earnings this past week.
Yeah.
And as those companies were able to charge more for power, selling power to companies like Microsoft and Amazon, they were able to just pocket more of that for themselves. So their profits went way up.
That's fascinating that they look at this from a different angle. But I do want to know when a hedge fund manager, when like a really kind of smart long-term investor looks at earnings, right? When they're looking at when NVIDIA reports, what are they looking for? They're not just looking at like, okay, what's the sales number? They already kind of feel like they know what that's going to be. What are they actually listening for?
They're listening for the future. What is management saying about what sales are going to be next quarter, next year? And if you think back a couple of years, what really kind of kickstarted the rally in NVIDIA was when they reported some outlook guidance for sales that was way above what Wall Street had expected. So whenever there's that big gap between what the company says they expect to earn and what Wall Street expects they're going to earn, you're going to see a pretty big move in the stock usually.
That's interesting. And that's often, I feel like when you open up the slides when a company reports earnings, it's like the first page has the kind of numbers that everyone knows. Oh, sales and profit. It's that last page where they're like 2025 guidance.
Yeah, you got to skip to the end. The answer isn't in the front of the book. It's in the back of the book.
Is that how you read most books? You just go right to the
yeah, who needs suspense?
Just bring me the heat. Well, I think that within this AI conversation, there's a lot going on, and the way that hedge funds have looked at the longer-term questions about power consumption, the fundamental infrastructure that will support a transition to using intelligence and stuff for day-to-day tasks. We dove into that pretty deep with our guest this week. Our guest is Chris Hansen. He is the founder and portfolio manager of a hedge fund, Valiant Capital Management. And Chris talked to us about not only big tech companies that are investing a lot in AI, like the Microsofts and Metas of the world, and chip makers like Nvidia, but about power companies, including, like you said, Vistra and Constellation. These are companies that provide the electricity that, like you said, fuels the data centers that are needed to support AI. Chris was gracious enough to talk to us while he was on the road about all of this. And we should note that Valiant is invested in a lot of tech companies, such as Nvidia, Amazon, and Microsoft, and in some of the power companies that we will talk about. So let's take a quick break, and when we come back, we'll have that conversation with Chris Hansen. Today, we are with Chris Hansen. He is the founder of a hedge fund, Valiant Capital Management. Chris manages a fund that's invested in power and power-adjacent sectors, stocks such as GE Vernova, Mitsubishi Heavy Industries, Vistra, Telis Energy, Willdan Group, among many others, I'm sure. Chris, welcome to the show.
Thanks for having me, guys.
So, Chris, last year you said that you saw what was the most hittable pitch in your history as a hedge fund manager. You also called it the most compelling thematic investment in your 30-odd years in the business. This was, of all things, power companies. To most investors, that would be kind of a snooze fest, right? Not very hedge fundy. Electricity, how fast could that possibly be growing? But tell us, what was it that you were seeing?
Our thoughts on power really developed initially from our work on AI. And the more work that we did on AI, preceding and immediately following the launch of ChatGPT and NVIDIA, like a lot of other people, led us down the path of just really trying to understand the power consumption forecasts how much power the forward forecasts of data centers and Nvidia GPUs would require. And we had kind of an aha moment in that we realized there wasn't going to be enough power to meet the data center demands and GPU demands that were being forecasted. So that really set off for us a path to try to understand a sector that we really hadn't spent a lot of time on. And I don't really think a lot of other people had spent a lot of time on, and that's understandable if you're looking at a sector that had 10, 15, 20 years of very low growth. And I still don't think people have grasped the extent of the problem and the opportunity.
So even just for the economy as it stands today, if you just took population growth and the devices and things we all do every day, you're saying that we've collectively underinvested in power generation, and it's difficult and takes a long time. So even without some big kind of driver like AI, you're saying we don't have enough electricity generation.
Let's put some numbers behind it. Our forecast is that power demand between now and 2030 will grow at about 4%. Those forecasts are based largely on forecasted, approved, and budgeted plans from grids and electrical utilities, regulated and unregulated, around the country. They're not Valiant estimates. They're a summation of scraped and downloaded data from these companies and grids. We can probably only add about 2%. And it is not just generation. I really want to make sure that people understand that you cannot build generation without transmission and distribution.
What was it that happened last year to some of these power stocks? With the benefit of hindsight now, you were talking about this investment last year. Now we know that some power stocks, particularly nuclear power stocks like Constellation and Vistra, surged in 2024. Constellation was up more than 90% last calendar year. Vistra was up well over 200%, both top 10 S&P 500 stocks. What was the catalyst that kind of woke people up to this what you describe as this kind of slow-moving thing that really we all should have seen coming? Like what catalyzed those stocks in 2024, would you say?
I would say that part is pretty simple and is fairly well understood in that the hyperscalers probably have a collection of the smartest people in the world working for them.
I want to say hyperscalers. Just can you define that for us? That's like the Nvidias, right? Those type of companies?
No, Amazon, Facebook,
okay.
or Meta, Grok trying to build out their data centers, Microsoft. They are obviously Google in the cloud business and have been building out cloud-based compute and now AI compute for a very long time. So they identified the power bottleneck. And so they started reaching out and trying to find solutions to ensure, Azure and Amazon both reached capacity on data center last year. So naturally, this is one of the most acute problems. And as they tried to solve this problem, they started trying to grab power where they could. And nuclear, if you were just to think about it at a super basic level, it's clean. No one wants to live near a nuclear facility. So there's going to be very little permitting issues, or environmental approvals required from putting a data center on a nuclear site.
Chris, I wanted to ask you, we're in a moment where, investors are moving a little bit away from ESG considerations. Is there a benefit for nuclear companies from this movement?
Of course, nuclear is the cleanest fuel that we have. You're talking about the time to build a new large nuclear reactor probably being realistically on the order of 20 years, maybe 15, but you can imagine all the where you're going to put one of the things, what would the pushback be, all the approvals required. Then we have these small module nuclear reactors, SMRs they're called, which are at least probably 8 years away, much smaller, probably easier to get approved. Not sure the technology is completely there. Still will not be enough. Not going to solve the problem. And if you think about it from a large IIP, which would be a, independent electricity producer, you could build a natural gas large-scale natural gas site, we have plenty of natural gas, which is also very clean. And you could probably have that up and running in 6, 7, 8 years with a defined cost, defined time frame, and defined ROI for you. If you want to build a nuclear facility, how do you know where power prices are going to be in 25 or 30 years to make this calculation? So new nuclear is really difficult, and that also makes existing nuclear more valuable. One of the things that happened, and we shouldn't miss this point because it's important not just to stocks but to America in general, is the regulator called FERC. If you look back at the nuclear deal between Amazon and Talon, says something very important. After approving their initial deal, the upgraded capacity that they were going to take, they said, wait a minute. Given the capacity constraints that we see on new generation and transmission and distribution, it doesn't really make sense to allow the hyperscalers to go around the country and just pull out capacity for themselves because everybody else is getting left holding the bill, whether it's industrial
Wow, the
companies or
regulator
resident.
stepped in to sort of say, let's slow this down. Wow.
Yeah, we need to slow it down till we can figure this out. And you at least need to be bringing new capacity into the market. So the answers aren't clear.
I just want to say for an investor who'd watched those nuclear companies kind of skyrocket last year, is it kind of too late, would you say, for them to get into them? Or should an investor just sort of think about these as a long-term play and not be thinking about the 2025, kind of repetition of 2024? How would you describe the right way to think about those stocks at this point?
I would say that every investor should make their own judgment, of course, and I'm not in the business to dole out stock-specific advice to people. But if you are interested in these stocks, you should remember that this is a very long-term thesis. It's not the type of things you want to be trading quarters over. And the costs to operate the nuclear facility are relatively fixed. There is going to be a huge amount of cash flow and predictability of that cash flow that is going to flow out for these companies over like a 20-year period. So the stocks have moved up in anticipation of that. But I still think if you have a very long-term perspective, they will be great things to own. I do think there's better things to own. I want to make that clear in this sector that will also be very long duration, great bets. But I think that's the framework that you should use for your analysis.
Chris, I do want to ask you about some of those opportunities, but maybe first, a more recent development that hit some of those power stocks was a few weeks ago when news broke that the Chinese model DeepSeek was said to run on a fraction of the power that competitors run. We saw a big sell-off in tech and power stocks. What did that development do to kind of your thesis on the whole sector there?
I would say the first thing I would say about any thesis that we would have is that it's important to always be intellectually curious and open to new information and not get grounded in any biases you have. So I think we have a very few unique takeaways. We did discussions in the subsequent just 3 days with 15 AI researchers. DeepSeek really showcased was reasoning and the power of a reasoning model, which is largely a new engineering technique for inferencing. So while they may have figured out a way to build the model cheaper, the way that we all interface with the model is by asking it questions, and that's called inferencing. And what DeepSeek's reasoning does is basically keep asking a question, trying to find the best fit for that answer. A reasoning question based on the research we've done and really just hearing from other people testing DeepSeek versus Llama 3 uses about almost 90% more compute and power than a normal inferencing request. And I don't think that part is well understood. So it is more energy intensive. Even if it lessens the burden on the model building, it is increasing the burden for the same request. The more useful it gets, the more requests we're going to submit. And the more requests we submit, the more compute, and power we're going to use.
We've got to take a quick break, and when we come back, we'll have one final question for Chris Hansen. In 30 seconds or less, the Trump administration says that it wants an all-of-the-above energy strategy for the U.S. Is there a form of energy that you see as benefiting the most from that kind of approach?
Definitely. We have plenty of natural gas. It's clean, widely available. So the longer-term answer for the U.S., I think, is natural gas. Maybe ultra long-term might be nuclear, but for the time period of which your listeners are listening, I think it's natural gas. And I think when we look backward in 20 years from now, that will have proven to be the thing that gets us through.
Well, we've got some 1 year, 2 year, 20 year, 50 year ideas here. Chris, thanks so much for joining us. This has been fascinating, and we really appreciate it.
Thank you guys for having me. It's been my pleasure.
Thanks, Chris.
Remember there was during Saturday morning cartoons, they would play a sort of ad council ad, like the incredible edible egg.
The incredible edible egg,
The incredible edible egg.
Yeah.
The incredibly expensive egg.
Incredibly expensive.
They should bring it back.